This podcast is for educational purposes only and is not financial advice. Welcome to the 15-Minute Investor. Today we're covering the critical inflection points hitting the markets this week, driven by some really key technical support levels on the S&P 500 and, of course, the anticipation ahead of that pivotal Federal Reserve rate decision.
It really is the main event.
And to put that whole macro picture into perspective, we're also going to do a deep dive, a technical and fundamental analysis of a major blue chip stock, Netflix, which is going through some pretty significant changes right now.
It feels less like a market and more like a high wire act this week. And you can see that tension in the indices. Right now, as we speak, the S&P 500, the NASDAQ Q, the Dow, they're all trading down.
The Dow the most, I assume.
Yeah, the Dow is showing the steepest losses. Investors are, they're clearly being extremely cautious. And that caution is rooted firmly in the charts.
Okay, so let's unpack that, the market structure. You mentioned the S&P 500 is teetering at a razor's edge. You've detailed these extremely critical, specific lines of technical support. But before we get to the numbers, when we say technical support, we're just talking about a price level where historically buyers have stepped in to stop the bleeding, right?
Exactly. It's the floor. And right now, we are testing the integrity of that floor.
Okay.
We saw a previous rejection point, where the price was sent back down near 688. But what's really putting the index in a precarious spot is the zone just beneath us.
And what's in that zone?
Well, if we crock beneath two specific prints that technical analysts watch very closely, the key $683 Blackpool print and the call wall at 685, it signals some major bearish momentum.
Hold on. For anyone listening who isn't tracking these daily structures, what are those prints? I mean, we're not just talking about simple volume here, are we?
No, not just volume. It's all about options positioning. The call wall is this huge concentration of call options at a specific strike price. It can act as a technical ceiling, or in this case, a floor.
And the Blackpool print.
That's similar. It often refers to a massive volume of dark pool institutional transactions right at that price.
So big money.
Huge money. And when institutions trade that much, that price becomes a magnet. Losing those magnets, that signals some major weakness.
And what's the ultimate line in the sand?
That is 681. That is the point often called the cliff. It's where technical analysts predict what we call precipitous flushing begins.
Rapid, aggressive selling.
Exactly. Stop losses get triggered, traders rush for the exit, and this whole technical drama, it's unfolding perfectly against the biggest macro event of the week, which is the Fed meeting.
Which brings us to the Fed watch. They're in their communications blackout period right now.
The mandatory quiet time.
Right. So no major public comments from officials until after the dust settles. The market, though, is not waiting.
No. And what's fascinating is that the market has already fully priced in the immediate action. The current expectations show, a greater than 80% likelihood the Fed will announce a rate cut on Wednesday. The cut itself is not the surprise.
No, the surprise, and really the source of all this tension, it lies 2 years out. Investors are focused entirely on 2026.
On the crystal ball, specifically the Fed's dot plot.
Exactly.
And for anyone who doesn't know, the dot plot is just a visual chart showing where each Fed member forecasts interest rates will be in the future. Right now, it projects 2 modest rate cuts for 2026.
But the market wants more.
The market is demanding more. What would satisfy investors, what would signal a truly dovish outlook, is a projection of 3 cuts. Not 2.
So even if they cut rates now, if that dot plot on Wednesday only confirms 2 cuts for 2026, that disappointment could be enough to push the S&P 500 right off that 681 cliff we just talked about.
That discrepancy between the 2 cuts projected and the 3 cuts demanded, that's the fundamental fuel for all this technical volatility. It's forcing everyone to just wait.
Okay, let's zoom out a bit. Let's look at broader market strategy as we navigate this week. We're right in the middle of what's often called the holiday wedge.
That's right. The period between Thanksgiving, Christmas, and New Year's. And historically, this seasonal window, it brings low floats, low volatility, and crucially, low momentum.
But it also dictates specific investor behavior, right? This is when people start looking at tax loss harvesting.
They get very serious about it.
Which, for you listening, just means selling assets that are down to realize those losses, which you can then use to offset gains elsewhere in your portfolio for taxes. It creates this temporary artificial downward pressure.
And we all have to remember, A Christmas rally is not guaranteed just because it's December. We learned that last year.
We certainly did. So if momentum is low, but volatility is high because of the Fed, where should long-term investors be looking to position their capital?
This is where we need to connect the dots and talk about the prediction from a prominent analyst, Tom Lee.
Tom Lee has earned a lot of credibility. He's been mostly accurate, especially in these volatile markets, and his current outlook is, well, it's provocative.
It is. He is projecting that the S&P 500 could experience another 20% correction from its peak.
Now, before anyone panics, it's important to emphasize the second half of that prediction, right?
Absolutely. He expects that correction to be followed by a very strong recovery. This is a forecast of opportunity, not just doom.
Okay, but let's run the numbers. If we see the market rally a little bit higher, say to 7,000 or 7,100, what does a 20% pullback actually look like?
If you calculate that dip, a 20% pullback brings the index down to approximately 5597. And what's crucial for long-term investors is why 5597 isn't just some random number.
Why is that number so significant on the charts?
Because that level aligns perfectly with prior technical support and resistance points going back several years. It suggests a potential repeat of a major buying opportunity.
Like that massive dip we saw back in April.
Exactly like that dip. Some traders called it Liberation Day. It was that moment the market dipped hard, but quality buyers just stepped right in and seized the opportunity. Hitting 5597 would trigger that same kind of psychological moment.
And that's the ultimate confirmation for long-term portfolio builders, isn't it? The breaking of the 200-day moving average.
That's the one.
A 20% pullback would push the S&P 500 and the QQQ, which tracks the NASDAQ Q, right beneath their 200-day averages.
Correct. And the 200-day moving average is considered the benchmark for the health of a long-term trend. When major indices break beneath it, it historically marks a massive entry point.
It forces you to think about what you would buy if you could get your favorite names at a 20% discount.
That's the strategic planning that needs to be happening now, while the market is still grinding near its top, not when it's already down.
So we've set the macro risk and the potential buy signal. Let's see how one major player, a quality asset like Netflix, is navigating this exact environment. The S&P could dip 20%. Netflix has already pulled back 30% from its top. What's driving this?
The story here is purely about protecting the competitive moat.
Their sustainable advantage.
Exactly. The news is all centered on its strategic move to acquire Warner Brothers, which of course includes the crown jewel, HBO, and all that associated streaming content.
And the rationale isn't that Netflix is desperate for content. It's more that they're preventing a powerful rival from even being created.
It's a preemptive defensive strike. They're trying to block someone like Larry Ellison or Paramount from acquiring those assets and instantly becoming a true scalable competitor.
And it comes at a huge cost.
And that cost is exactly where the short-term pain is coming from. The immediate headwinds are substantial. You've got opposition from Washington over monopoly concerns. The Writers Guild has publicly called the deal a disaster.
And what about the financial side?
The debt load alone is significant, over $32 billion being added to the balance sheet. Plus, existing shares will be heavily diluted, maybe 10% to 20%. And there are reports they may have overpaid, coughing up north of $72 billion.
So you have all this uncertainty that could last, what, a year and a half with regulatory oversight?
At least, so it raises the question.
Yeah.
Why accept this pain now? And the long-term rationale, the catalyst, is explosive profitability and market share dominance.
Even with that debt load.
Even with the debt. $32 billion is massive, but it's viewed as manageable for a company with Netflix's cash flow. They can recover costs pretty quickly by leveraging the added value, all that new content, and just raising subscription prices.
And for the user, it actually creates a lot of value. If you can bundle HBO and Netflix and everything else into one service, you might actually save money. It makes their offering a lot more sticky.
The long-term outlook is clear. Once this near-term debt and regulatory noise is priced in, Wall Street is going to pivot its focus entirely to 2026. And by then, the combined company is projected to be a much more dominant, profitable machine. Analysts think it could eventually run the stock up toward $150.
Okay, let's shift from the fundamentals to the technical chart. The stock is down 30%. It's trading beneath its 200-day moving average, which we just said is the macro buy signal. If buyers are waiting, where exactly on the chart are they?
The charts give us a pretty clear downside target using Fibonacci analysis. The potential technical bottom is near $89.44.
All right, break that down. When you say the $89.44 level is the 382 shallow pullback Fibonacci level, What does that mean in simple terms?
So Fibonacci levels are just mathematical ratios that often predict human behavior in markets. When a stock is in a healthy long-term uptrend, it usually pulls back to specific levels before it continues higher.
Okay.
The 38.2% level, the 382 fib, is the shallowest pullback a strong stock makes. So if this stock is genuinely going to continue its upward trend, this $89.44 spot is the very first technical line in the sand it has to bounce off.
And if it doesn't hold there?
That would suggest a much deeper, more concerning problem.
But the chart is also flashing a very famous, very frightening warning signal, the death cross. The 50-day moving average just crossed below the 200-day. Why the dramatic name?
The name is dramatic because it signals a profound shift in momentum. It happens when the short-term price strength, the 50-day average, falls beneath the long-term trend line, the 200-day. It signifies that short-term selling is overwhelming the long-term uptrend.
And the historical context for the death cross here is conflicting, which makes this so difficult.
Exactly. We have two very different precedents. In the negative case, if you look back at the 2022 recessionary environment, that cross signaled the start of a much bigger problem. It preceded a further 50 to 60% drought.
Ouch. But the positive case is completely different.
Completely. In other, more bullish environments, the death cross was followed by a brief period of consolidation where buyers accumulated, and then an explosive 55% rally happened in a very short time.
So the outcome for Netflix depends entirely on one question for you, the investor. Is the overall market heading into a full-blown recession in 2026?
Right. Is the big tech AI story truly over? If yes, the death cross is the alarm bell. If no, it's a massive discounted buying opportunity.
And this is where a third technical clue might break that tie. The Bollinger Band indicator. The price is recently printed decisively outside the lower Bollinger Band.
Right. The Bollinger Band is basically a measure of volatility around a stock's moving average. When the price prints outside the bands to the downside, it generally suggests that the downward move has become statistically abnormal. It's overheated or over-exaggerated.
Meaning the selling has likely become exhaustive.
Precisely. It suggests the stock is historically due to cool off and move back toward its average price, which would mean moving higher. That signal, combined with the major support level, suggests a short-term bounce is possible at any moment.
So a death cross suggesting long-term risk, but a Bollinger Band suggesting short-term seller exhaustion.
Great.
This leads us right into the actionable plan.
And the key lesson from prior dips, whether it was the 2022 bear market or that Liberation Day dip in April, is the absolute importance of having cash ready.
You don't want to be scrambling when the big signal hits.
Never. So for new money entering a brokerage account right now, I would recommend a very cautious approach. Put only 20, maybe 25% of that new money to work in the market right now.
And the rest.
The vast majority, 75 to 80%, should be held in cash or high-yield savings. This cash is specifically earmarked to deploy during a substantial correction, like that 20% pullback we talked about.
You participate if it goes up, but you're ready for the big dip.
Exactly. And regarding Netflix specifically, even with the Bollinger Band suggesting a bounce, the true first technical target for a decisive long-term reversal is still sub $90, right near that $89.44 some fib level.
So be very cautious with short-dated options until we see a confirmed reversal there.
Absolutely. The definitive reversal is not yet in place.
So we end on that central provocative question. You have a major blue chip stock down 30%, adding debt to defend its moat. The question you need to wrestle with is this. Is this dip simply a temporary strategic correction that will resolve into explosive profitability by 2026?
Or is the speed of this pullback, combined with the death cross, an early warning that the entire big tech story is over and a wider recession is coming?
The implications of that choice will define your portfolio for the next 3 years.
And if you choose the latter, that 5597 number for the S&P 500 becomes a near certainty.
Okay, let's quickly hit the key takeaways for this deep dive. First, the S&P 500 faces critical technical support below 681 ahead of the Fed rate decision. Crucially, the market is demanding more than the currently projected 2 rate cuts for 2026.
Second, analyst predictions suggest a potential 20% correction in the S&P 500. This would bring major indices beneath the 200-day moving average, a critical technical signal marking a key long-term buying opportunity.
Third, Netflix's acquisition of Warner Brothers and HBO creates significant near-term debt and dilution. However, this move is viewed as a necessary strategic defense of their competitive moat, expected to lead to huge profitability by 2026.
Fourth, technically, Netflix is flashing conflicting signals. The death cross is bearish, but printing outside the Bollinger Band suggests the move is overdone. The technical floor to watch for a major rebound is near that $89.44 Fibonacci level.
And finally, the recommended investor strategy is to maintain substantial cash reserves, maybe up to 75% or 80% of new capital, to capitalize on a predicted market pullback. Deploy a little now, but hold most of your cash to be ready for the deep, long-term buying opportunity that may be just ahead. Thanks for listening to the 15-Minute Investor.